In this video, I'll be talking about amortization and depreciation. So let's get started. Now, amortization and depreciation are essential accounting concepts used to systematically allocate the cost of assets over their useful life. While they serve a similar purpose, they apply to different types of assets. Now, first of all, we're going to be looking at amortization. So I'm just going to write down the heading, amortization. All right. So this is the process of spreading the cost of an intangible asset over its useful life. Intangible assets are non-physical assets that have economic value, such as patents, copyrights, trademarks, and goodwill. Now you might be wondering, how does it even work? So I'm just gonna go ahead and write down the steps. Now the first step is to determine the useful life. So determine useful life. Now if you're wondering, this is the useful life of the asset, more specifically the intangible asset. Now the estimated period over which the intangible asset will provide economic benefits to the company, that's basically the useful life. Then you'll have to calculate amortization expense. So calculate amortization expense. So the cost of the intangible asset is divided by its useful life to determine the annual amortization expense. Then you'll have to record amortization expense. Record amortization expense. So these are the three steps. So the last one basically means that the amortization expense is recorded as an expense on the income statement and reduces the asset's value on the balance sheet. Now, we're going to look at an example of amortization so that it's more clear for you on how it works. So let's say a company purchases a patent for $100,000 with a useful life of 10 years. Now the annual amortization, or basically per year, is gonna be obviously, I'm just gonna write with another pen, the color pen, it's gonna be 100,000, which is the original price, divided by the useful life. So as I said, the useful life is 10 years. All right, and this gives us $10,000. So that's our annual amortization expense, and this expense would be recognized each year over the 10-year period, all right? So that's it for the example. Now we're gonna go ahead and look at the pros and cons of amortization. And first, we're gonna be starting with the pros. So I'm just gonna go ahead and write down below this. The first pro that we have is accurate financial reporting. Accurate financial reporting. Now, it provides a more accurate picture of a company's financial performance by matching expenses with the revenue generated from the intangible assets. Then we have tax benefits. Tax benefits. So, amortization expenses reduce taxable income, leading to lower tax liabilities. And lastly, we have asset valuation. Asset valuation. So it helps in determining the fair value of intangible assets on the balance sheet. So that is basically it for the cons. Now let's go ahead and look at the cons. I mean, that was it for the pros. Now let's look at the cons. So the first con that we have is estimates and assumptions. So I'm just going to write it with a red color pen on top. Estimates and assumptions. So, determining the useful life of intangible assets can be subjective and subject to change because you're obviously not sure of what the useful life is going to be. It's always an estimate. Then we have complexity. So, accounting standards for intangible assets can be complex and subject to interpretation. All right, so that is pretty much everything you guys need to know for amortization. Now we're gonna look at another similar concept, which is depreciation. So I'm just gonna go ahead and write down the heading. So I'm just gonna write it here. Depreciation. All right, perfect. So depreciation is the process of allocating the cost of a tangible asset over its useful life. Now, tangible assets are physical assets that have a physical substance, such as property, plant, and equipment. Now, when we looked at amortization, that was for intangible assets. But for depreciation, it's almost the same thing, but it's for tangible assets. Now we're gonna look at how depreciation works as well. So I'm gonna go ahead and write down the steps. The first one is obviously the same one because it's determining the useful life. As I said, they're very similar. It's just about whether it's intangible or tangible. So this is basically the estimated period over which the tangible asset will be used by the company. Then we have estimate salvage value. Estimate salvage value. So this is the expected value of the asset at the end of its useful life. And then we'll have to select a depreciation method. Select depreciation method. Now, obviously, we don't have only one method. We have quite a lot of methods. So let's go ahead and look at them. Now, the first one that we have is the straight line method, which allocates equal depreciation expense each year. So basically, let's say we have an object or asset which is worth $100. Okay, now let's say the useful life is gonna be 10 years. Now obviously we're gonna do 100 divided by 10 because it's for 10 years and it's gonna give us 10. So basically $10 is our depreciation expense each year. So basically we're dividing the expense into equal number of parts depending on the number of years we allocate. Now the second method that we have is accelerated depreciation. Accelerated depreciation method. So now this is basically where you allocate more depreciation expense in the earlier years of the asset's life. For example, double declining balance method. Now this applies a fixed depreciation rate to the asset's book value each year. And then we have some of the years digit method, which allocates depreciation based on a declining fraction of the asset's depreciable cost. All right. And then lastly, the last step is to calculate the depreciation expense. So calculate depreciation expense. All right. So the depreciation expense is calculated based on the chosen method and recorded on the income statement and the balance sheet. Now let's look at a similar example that we looked with amortization. So let's say a company purchases a machine, which is a tangible asset, for $50,000 with a useful life of 5 years and an estimated salvage value of $5,000. Now, using the straight line method, which we discussed earlier, where you're gonna allocate equal depreciation expense each year, the annual depreciation expense would be 50,000 minus the 5,000 salvage value divided by 5 years, all right, which is gonna give you 9,000 if you go ahead and calculate it. Now, we're gonna be looking at the pros and cons of depreciation. So let me just get my pen out. All right, but let's get started. So the first pro that we have is accurate financial reporting. They're pretty much similar because they have similar purpose, amortization and depreciation. So accurate financial reporting. All right. So it provides a more accurate picture of a company's financial performance by matching expenses with the revenue generated from the tangible asset. Then we have tax benefits, which is again similar to amortization. So depreciation expenses reduce taxable income, which leads to a lower tax liability. Then we have asset valuation again. Asset valuation. So it helps in determining the fair value of a tangible asset on the balance sheet. The next one that we have is conservative accounting. So I'm just gonna go ahead and write this on the top left corner right here. So it is conservative accounting. So by spreading costs over time, companies avoid overstating profits in the short term and understating them in the long term. Then we have improved decision making. Improved decision making. So, accurate financial information enables better decision making regarding capital investments, asset replacements, and strategic planning. All right, so that is it for the pros. Now we're going to go ahead and look at the cons. The first one is almost the same, which is, I'm just going to write it here, estimates and assumptions. Well, this is because you're obviously estimating the useful life and the salvage value of the tangible asset, which is again subjective because you're never sure about it. Then we have potential for manipulation. Let's look at that now. Potential for manipulation. So, companies may be tempted to accelerate depreciation to artificially inflate earnings or reduce tax liabilities. And then lastly, we have complexity, which is again the same thing with amortization. So different depreciation methods can lead to varying results and require careful consideration. So that is pretty much it for amortization and depreciation. So I've gone through each of the concepts, explained an example along with the pros and cons of each of them. And I hope this video helped you out, and I'll be seeing you guys next time. Peace out.